Well, equities continued to rally last week amid signs that calm continues to prevail in the banking sector, and we also had some supportive month and quarter-end flows in the mix as well. Elsewhere, the dollar continued to roll over despite quite a chunky jump in treasury yields, especially at the front end of the curve again, as markets breathe a sigh of relief that financial stability issues may well be behind us. The new month and new quarter is already off to a surprising start for the markets after OPEC announced a 1 million barrel per day output cut over the weekend. Plenty to look forward to in this holiday-shortened week, including the latest US labour market report wrapping things up on Friday, giving us tons, as always, to discuss in the trade-off this week. So without further ado, let's get into it. Well, as I said, it's a new week, it's a new month, it's a new quarter as well. And if you're Japanese, it's a new financial year for you too. So it's already off to a busy start. Without further ado, let's bring in Ryan Littlestone from Forex Live and Forex Analytics. Ryan, good morning. How are you doing? How is it down in sunny Spain at the moment?
Yeah, it's lovely down here. Nice to be walking around with some shorts on rather than a scarf and a woolly hat.
Yes, I bet. Well, I hope you're topping up on the sun cream, that's for sure, because
yeah,
you're going to need it by the sounds of it down there.
Especially with this hair, yeah.
I didn't want to go there. Cool. Well, without further ado, it's the quarter's already off to a busy start, so let's get into Topical Thunder. I want to start with a little bit of a look ahead, really, to the next month or, well, the next 3 months, I guess, given that this is, well, when we're recording this, of course, the first day of the third quarter. We had quite a bumpy Q1, that's for sure, but actually we seem to end it on a relatively positive note. Equities on Wall Street notching their third straight weekly gain, the NASDAQ rising 20% from the lows that we saw last year, so back in a technical definition of a bull market, if nothing else. We've also seen volatility come quite nicely lower as well. The VIX back below 20 this morning, and the MOVE index, which of course tracks volatility in the fixed income space, is pretty much as near as makes no difference at the level we were sitting before all of the Silicon Valley Bank and Credit Suisse shenanigans kicked off. I think looking ahead into the second quarter, the story is one where, for me at least, I'm keen to get your views on this, of course, right? It's almost a no news is good news mantra for the markets. All the time, we're not getting any more banking failures. All of the time, things are relatively stable, and we're getting some decent economic data coming in as well. The momentum is probably going to remain with the bulls. And of course, the other thing filtering into that is you've got a lot of cash on the sidelines. Nobody is going to want to miss out from the next rally. And if we see volatility continuing to come lower, that is going to keep enticing some of these institutional real money funds into the market, which will spur another round of buying, spur vol lower, and we could even, for a few weeks at least, end up with something of a virtuous cycle, I guess.
Yeah, most definitely. And it's always difficult when we roll over the start of a quarter, or roll over the end into a new quarter, particularly for this one being the Japanese year end as well, financial year end, start of the new year. And I tend to, sometimes I hate this time of year, the end of the quarters, because we see a lot of flows going into the end of the quarter, and sometimes they can just roll over into the start of the new quarter. So you get some of that momentum that we saw previously the last few days happening in the first couple of days of the new quarters, as you know, firms put on newer positions, things they had to rebalance at the end of the month, end of the quarter, they put on again in the new quarter. So it's always a bit of a funny time. I'm not too certain whether what we saw coming into the end of the quarter continues into the new quarter, but that's what we need to look out for. Are these moves something different and continuing, or was it just end of month, end of quarter flows that are going to recede, and then we get back to trading the fundamentals, the central banks and everything else like that?
Yeah, exactly that. I totally agree with you. I think it's always a little bit of a sort of unusual and difficult time to trade, given that you just don't know how many P&Ls have been reset to zero, what positions have been wiped, what's still on, where's the flow, all the rest of it. And of course, OPEC throwing in a 1 million barrel per day output cut into the middle of that is exactly what we all needed, isn't it?
Exactly. Yeah, I thought they were going to scupper one of my charts later on, but all seems to be going okay for that one.
Well, sadly, they did scupper one of mine, so I had to update that furiously on my way into the office this morning. What about some of the buzzwords we've got to look at? Because we all love a buzzword, don't we?
Yeah, we've heard some of these buzzwords already, and they become key for particularly what the central banks are doing. We had it from Powell, looking at tightening financial conditions. That's their keywords, their buzzwords, as to what they're looking at to see whether this banking issue that we've just come through is going to affect conditions, going to affect the economy, and various aspects of the data. So the one for the Fed is tightening financial conditions, mentioned several times by Powell and co. So where can we monitor that? Well, it's things like mortgage levels, the rates charged, something like the MBA show the effective 30-year rate. So seeing if mortgage rates are affected by this tightening financial conditions, that's going to play into other things such as the main housing data, prices as well. We saw decent housing data coming out last week, but some of the price components just looked like they were a little bit softer. Also, things like retail sales. So when you get tighter financial conditions, those are the areas they're going to impact the quickest, if you like. Then we look at the ECB, Lagarde and others talking about the baseline scenario. So they said right from the start, before the banking stuff, if their baseline continues as it was before the banking crisis, then they're going to go back to hiking or continue hiking. So it's whether it's looking at the data to see, is it changing their baseline, as they keep putting it. That's looking at the PMIs. That's looking at inflation, as you're going to speak about shortly. And then you've got someone like the BOJ, which is looking at real wages. We know that they've had this jump in wage negotiations up to sort of 3.8%. Are those wage gains going to turn into real wage gains? That means after you've adjusted for inflation, are they going to be positive numbers? And, they're holding inflation. Is it going to hold above 2%? If it does, as it becomes more ingrained, that's perhaps going to feed through to the data and then start to maybe get the new man coming out a little bit more hawkish or moving away from easing, at least in small parts by, starting with the language. So all these key buzzwords, I won't even talk about the ones at the Bank of England because they've got more buzzwords than the dictionary. But those are the areas we need to be looking at to see whether central banks are going to go into full pause or whether they're going to get back on the hike bike.
Yeah, most certainly. I think I'm glad you mentioned the Bank of England at the end there, because I don't think they know what they're looking at, let alone us trying to guess what they're looking at. I think it's interesting you talk about financial conditions, because I think this is something that is a little bit misunderstood. And this ranges from, the novice retail trader all the way through to some of the sell side stuff that you read. From what I can gather and from listening to and reading some of the Fed speeches, what they're really focused on is what you rightly alluded to. How is this impacting the real economy? How is it impacting borrowing, whether that be mortgages, whether that be loans to consumers or to businesses? How is it impacting retail spending, all that sort of thing? What the Fed aren't particularly concerned about, at least from what we've heard in recent remarks, is market-based indicators of financial conditions, for want of a better word. We've seen a Fed previously, you think before COVID, where it was a Fed that was very concerned with the level of the S&P, the level of the dollar, the level of the 2 and the 10-year yield, where the VIX is trading, all that kind of stuff. I don't think the Fed are too bothered about that at the moment. I think what they're really focused on is how financial conditions are impacting the real economy. And that is where you start to think about actually this slowdown in credit creation and loan growth that we're likely to see out of the back of some of these banking failures. We then start to think about, to what degree is that going to act as effectively a rate hike? Is it going to be 50 basis points worth of hikes, 100, 150? We just don't know. And that's another headwind that the economy is going to have to battle as we move through this quarter and actually probably into the remainder of the year. Touching on the ECB, as you said, the baseline forecast, personally, I don't think that baseline is actually worth the paper that it's written on. They released it on, I think, the 8th of March or maybe the week after that. I can't remember when the ECB was now. But it was actually based on where the economy was, where the euro was and all the rest of it at the end of February. And we're a hell of a long way off that at the moment. The macro economy is very, very different indeed. So I think the ECB referring to their baseline in speeches and things like that, I mean, you know, it's totally pointless because your baseline, it was out of date before you even published it. And then the BOJ, I think that's where the real interest is. Obviously, UEDA now at the helm. The BOJ is towards the tail end of the month. I know we're going to look at the yen in a few minutes' time, but I think that's where the real action is. I mean, you've got the Fed, they're probably going to give us one, maybe two more hikes, similar from the ECB. The big unknown is the BOJ, so that's where the interest is for me.
Yeah, definitely. But we've got to be careful also about the details. There was a story out last week, I think it was the WSJ or the FT, saying that bank lending had been cut in the Eurozone to, you know, households and firms. And you think, oh, that's a big headline. And it was based on what Lagarde produced, something in her statement, like you say. But it wasn't specific. It didn't say whether banks had actually cut lending or whether lending was just down and why it was down. Was it down because banks had stopped lending and had actually cut lending? Or was it that people just weren't borrowing as much? So there's a big difference when you get headlines like that. You need to know what it is. Is it people stop borrowing because the costs are higher? Or is it banks actually cutting lending because they're worried about, you know, passing on too much debt onto consumers? So that sort of thing we need to get into and understand where the stresses may come from, if they're going to come from anywhere.
Yeah, absolutely. That, as always, headlines can be deceiving. Cool. Well, let's get on to inflation. And I'm afraid my headline may be a little bit deceiving here because I've said headline inflation has rolled over. It has, but it might not for much longer. And the reason for that is obviously OPEC. They're cutting oil's output by 1 million barrels per day from, I think, the start of this month through to the end of the year. That is not only an inflationary blow to the global economy, but also a stiff growth headwind that we'll have to deal with. Higher oil prices, denting demand, all the rest of it. But what we're seeing in the indicators at the moment, and the OPEC news over the weekend only reinforces what I'm about to say, is a massive divergence between headline inflation and core inflation. So when you strip out energy prices and food prices from your inflation measures, you get a very, very different story. And I think the Eurozone is a really good example of this. Last week, we had on Friday, I think it was, the flash CPI data for March. Headline CPI came in at 6.9% on a yearly basis. That's not exactly great, but it's down from 8.5% that we saw in February. And that's actually the biggest 1 month drop that we've seen since the creation of the Eurozone. So going back to your point a moment ago, mate, if you read the headline, inflation, biggest 1 month drop ever, big smile on your face, down the pub, crack the champagne or the Prosecco maybe, off you go to celebrate. When you dig into the data, you look at the core number, take out energy, take out food, you're at 5.7%. That's a new all-time high. And the core inflation print shows absolutely no sign of slowing down in the Eurozone. If you look at some of the data coming out of the US, you're seeing a very similar picture. If you look at the PCE and the core PCE numbers we got on Friday, they pretty much tell the same story. Core PCE remaining pretty much unchanged at 4.6% on a yearly basis, while the PCE number comes down very nicely. And this is pretty much mirrored everywhere. You've got the same story here in the UK as well. And I think what this is showing, or what this tells me at least, is actually, despite what central banks are saying around inflation expectations not becoming de-anchored from their target, price pressures are starting to get embedded and starting to get entrenched in the economy, no matter where you look, as you can see from these core CPI numbers. And of course, an oil production cut is only going to make this problem worse. And I think when you then look at the market pricing that we've got for rates out to the end of the year, when I looked yesterday afternoon, this will have changed slightly. The Fed, we've got about 60 basis points worth of cuts priced, around about 20 bips from the BOE and the RBA, and around 10 from the ECB. That, to me, still looks overdone. And I think, although we've had all of these shenanigans with the banks, the higher for longer, for me, is back on the cards.
Yeah, I tend to agree. You know, we've seen inflation rising in, you know, France, Spain, as example, on all measures. So it's not a straight line, as we know, with inflation. Oil's going to be important, of course, but that tends to have a more of a shorter term impact on headline inflation, whereas the core lags a bit. So if headline inflation keeps edging lower, probably the core is going to catch up at some point, but how long that takes is the question. Oil, it's we're not really going anywhere new. We're sort of in this 60, 80 buck range, have been for a while. You tend to need to see inflation trending oil trending in a particular direction before you think that inflation is going to, add or take off from those moves. But I've said it all along. It's not where inflation keeps coming down. It's where it settles, and I think it's going to be settling quite high and higher than many expect. Maybe around sort of 5-6% mark, maybe even down to 4%. I think it's a long way before we even see the 2% again, and unless we really see the economies faltering, retail sales dropping off a cliff, all sorts of lending dropping off a cliff, and then we enter a sort of disinflationary environment where firms need to cut prices to get customers through the door. But it is going to be sticky. And yeah, I think it's going to reinforce the higher for longer, because the central banks aren't going to want to let it off the hook again. Inflation, they want to get the genie back in the bottle as much as they find it difficult to do so.
Yeah, absolutely that. And I think the other thing that's important when it comes to inflation, and I'm sure most of our viewers understand this, but I don't think the understanding of this in terms of the general public is particularly high. Just because inflation moves from 10% to 2%, it doesn't mean prices are going to go down. It just means they're going up at a much slower rate. So actually, although central bankers may start to do a little bit of a victory lap as we get closer and closer to 2%, that doesn't mean we're going back to where we were before, where a pint was a fiver. Your beer is still going to be £7 if you're in the city of London at the very least. It might be cheaper down on the beach where you are. But what about jobs? What about jobs? We've got the payrolls number coming up, and really nicely, someone has decided to release it on Good Friday.
Yeah, what is that about? We've got all the US markets shut, most of Europe shut, and we've got tier one data coming out on a Friday. It's absolutely bonkers. We talk about Easter eggs. This could be a real omelette coming up on Friday.
Oh, very good.
Yeah, and it's a busy week all round. We've got the ISMs dropping as well. So what do we need to look at for this one? Well, obviously jobs is the hot topic. We play this never-ending game, when will the jobs market roll over? And so far it's confounded everyone. It would be typical if we got a really bad print on a Friday when all markets are shut and everyone's sitting around in holiday mode. But that presents an opportunity. It's two things. It means there's not going to be any liquidity. So for us retail traders, our CFDs and markets will be open, FX will be open. So there's going to be a real lack of liquidity there. So it's going to be volatile potentially if there's a big variation in the number. But also it gives us an opportunity, because if it is a big outlier number, the market's going to react to that when it reopens. So if things haven't really moved on the Friday for us retail traders, say we get a really bad number and we don't see any real big moves in markets as we would expect had everything been open, there's potentially an opportunity to get into positions waiting for that reopening on the Monday, and then the market reacts and gets stuck into it, and we get a move as we would have expected on the day. So there's big risks for us retail traders, but there's also potential good opportunity for that. And as for the jobs themselves, if it's a good number, that moves the Fed further away from this bank crisis that we've gone through, gets them back towards their path. But if it's a bad one, all hell could break loose.
Yeah, exactly that. I mean, I haven't got my random number generator out yet to put my guess in the Forex Analytics sweepstakes, but I'm sure that will be coming a little bit later on this week. So do keep an eye out for that. There we go. Free little plug for Ryan. In terms of the actual market reaction to the jobs report, I think it's going to be one of two extremes. Either nothing's going to happen, or it's going to be absolute chaos. And I was working out what's open and when, and what closes and when yesterday. This was my fun Sunday afternoon. And I believe treasuries are open until 12 o'clock New York, so 5 o'clock here in London. But equity futures, commodity futures are just shut entirely. Equity futures are only open for about 45 minutes after the jobs number drops. So I think there could just be a massive scramble to put positions on, take positions off, really reduce risk as you go into the weekend. But as you say, that gapping risk on the Monday morning or the Sunday night, depending on where you are, is very, very significant indeed. We saw that this week with oil, with the NOK, with the CAD, for instance. I think we could see that on a much bigger scale next week after the jobs number. In terms of the print itself, I don't think we're going to see any signs of the jobs market rolling over just yet. I think the consensus is around 220, 225 from when I looked on the way in this morning. Unemployment should remain about 3.6%, earnings rising by about a third of 1% on a monthly basis. So if you get numbers like that, it's pretty much a Goldilocks story once again, and that should keep the Fed on their what is now quite a well telegraphed path. But as you say, the real interest and the real vol that we could see is going to be on a big beat, so probably above 300-ish on the headline payrolls number, below 3.4 or below on the unemployment rate, or a big miss if you get a jobs number below 150-ish and an unemployment rate 3.7, 3.8. That will set a bit of a cat amongst the pigeons. But the last thing I want to talk about on jobs before we move on is on unemployment. As we saw last month, the rising unemployment rate is not necessarily a bad thing. If unemployment rises because participation is rising, because more people are coming into the labour market, because more people are looking for a job, that's actually a positive, and that's exactly how the Fed would see it. So if you do see a bit of a risk-off move on the back of rising unemployment, it could be one to fade, because actually, depending on the breakdown of that report, and again, this is why you dig beyond the headline, that could actually be a positive for the US economy and for Fed policy going forwards. Cool. With that said and done, let's move on to some charts. Well, charts, please, Kyriakos. We're going to start with the S&P 500 this week. This is something that we looked at last week, so I'm bringing it back this week to, one, make my life easy, and two, prove that Ryan and I do sometimes know what we're talking about. 4,050, we were mentioning that this time last week as a big level. As you can see on the chart there, we've tested it 1, 2, 3, 4 times in the past as we go through this year, and it's been very key marking out whether we're in a bearish or a bullish period. We got a closing break above that level on Wednesday, and the bulls haven't really looked back since. We've had probably 100 points worth of gains above that. Banks solved, inverted commas, end of month, end of quarter flows helping along, a bit of stability in the treasury market. Fed pricing hasn't moved too much. It's giving the bulls quite a lot of fuel and quite a lot of energy to push higher. And I think 4,200 does look like it could be on the cards in the short term, barring any nasty surprises in the jobs number on Friday, of course. The other thing you've got to bear in mind is, and I'm not a huge fan of this sort of thing, but April is traditionally a pretty solid month for equities and for the S&P 500 in particular. So the momentum seems to be pretty strong. What do we have to look out for? Well, from a fundamental point of view, you've obviously got the jobs number Friday. You've got the next US CPI number in the middle of the month, and also earnings season, which kickstarts with the banks on the 14th of April. But I think personally, while we're above 4,050 and also while we're above the 50-day moving average, over the medium term, I would certainly be looking to play this from the long side. Ryan, what are your thoughts here?
Yeah, it's been a one-way street really since we had those lows down in the 38s. It's gone one way, and it's been strange because I still think we're moving out of this. Risk off means good for stocks, but perhaps we got a bit of that on Friday with those PC numbers. And I think there was one of the regional banks had one of their many core PCE numbers released, and it showed a big drop, and that seemed to spark this move as well. But 4,200 I think is very much achievable. Technically, it'll be interesting because if we hold there, it gives us a bit of a range to play. We know we can lean against the 4,200 for shorts perhaps. Maybe for a move back to 4,000. I don't see us going anywhere significant right now unless we get some real changes to the data, good or bad, and the market obviously then rearranging their expectations for the Fed. So I think the trend is your friend for now, and it's probably a buy the dip market.
Yeah, I would agree with that. I think the key test is what happens at 4,200. Anyway, Spain, seeing as you're there, I like the fact that you've chosen the IBEX as your chart.
Yeah, well, you know what they say when in Rome, but I'm not in Rome. I'm not even in Madrid, but I'm in Spain. So hopefully I haven't with 2 countries there. But yeah, we might as well keep it topical and look at the Spanish IBEX and, pretty much following all stock markets. And Spain is one of these countries which it can tend to move a bit faster on the data. It was one of the first to start showing inflation dropping. It's one of the first to show a pickup in the other economic data. It's doing very well. If you look at the PMIs, manufacturing moved into expansion again at the last read on the flash number. Services moved into very strong uptick there. And Spain seems to be outperforming some of the other peers, like Italy, France, and even Germany. And probably everyone's outperforming Germany at the moment, but it's looking pretty good. And I'm looking at the chart here, and we're on a bit of a support level. And I think again, this is a buy the dip market, and if we get a hold here at these current levels, then we should be pushing up towards those recent highs. So longs is what I'm favouring in this one. Again, I think we're switching this risk narrative. Where risk off means stock market up. So I think we're trading on the fundamentals. Obviously, the ECB is continuing on its high path, and stocks are still seeming resilient. So if this early theme continues as we've come out the quarter into the new one, then dip buying is your opportunity and lean against a decent support.
Absolutely. I think it's very much a kind of rising tide lifts all boats at the moment, whether you look at the IBEX, whether you look at other European indices, the S&P, or even if you start looking into Asia as well, actually, I think it's a case where, yes, there is going to be a bit of divergence on a geography and on a sector specifically. You're going to see tech do relatively well, I would expect, particularly if rates remain a little bit more subdued. But yeah, absolutely. I think it's a case of if Wall Street's doing well, then chances are everything else is going to rally along with that. I think that's the first time we've ever kept a segment to time. So let's try and do that again. Dollar yen, it's been an awful ride for the yen last week. I think rates are clearly the main driver of the yen still. So when you've got the 2-year rising, 25, 27 basis points on the week, I think it was, that's the biggest rise since last September. It's always going to be tough for the yen to gain ground. And of course, you've got the end of the month, end of the quarter, end of the Japanese financial year in the mix as well, which always does muddy the waters just a little bit. I think the yen's interesting because we're quite delicately poised here, actually, and I've drawn as many lines on this chart as I can to give Blake Morrow plenty to steal when he comes to do his version of the trade-off later on this week. Yes, Mr. Morrow, that has been noted. But I think it's interesting because we're sat here right on the 50-day moving average. And as I said, this is a pretty delicately poised market. If we get further signs of calm on the financial stability front, if yields continue to just plod slowly but surely higher, if risk continues to rally, then perhaps you start to look for a break of this 50-day, and you would then look for the market to perhaps move back towards this kind of 134.5 region, which is marked in white there and has been a very key support and resistance level for the pair going all the way back really to the tail end of last year. But of course, if we fail to break above the 50-day, and of course a closing break is really what we're looking for as always, then maybe we're in for a little bit more downside. If the Fed aren't as hawkish as the market expects, if we get a bit of a miss on that jobs number on Friday, then we could take a trip back down to the support there, which comes in around the 130.35, 130 level. So good levels to play this from either side. Personally, I'm happy to sit on my hands, wait and see how the market plays out in the early part of this week before taking a definitive view on things. But of course, you've also got the BOJ at the end of the month as well, and the market will be biding its time until we hear from UEDA in the mix as well.
Yeah, and this has been one that's needed to be watched because we've had some moves, obviously, with the Japanese year end and start of the new year. And, I was looking last week for maybe a move down to the 127, 128 area to get into longs, just to get back on the boat if you'd like. With the BOJ being maybe staying on their dovish path. But then we got a couple of headlines out from Kuroda and Uchida, one of the guys coming in. And, they almost have opened the door for UEDA to maybe move to tightening. I think Kuroda said that there's never been a better time when inflation may move to their target and may be sustainable and allow the BOJ to change. And that was strange because those comments come out pretty hawkish from Kuroda, but the yen didn't move on it. And that struck me because I thought, okay, right, well, then we really are trading some flows here. And I think I'm shifting again towards the short side. If we get a decent rally, like you're saying, up through 134, 34.5, I may be tempted to start looking at some shorts to run into the Bank of Japan because maybe the door, there's a chink of light on a bit of a change coming.
Indeed. I'm sure that's one we'll get into as the month progresses. What about the euro? Because I'm surprised you chose this, if I'm being honest, because it's been a little bit boring of late.
Well, boring can be good, particularly if it's ranging. And, we've had a break of the range. We've been watching this 105, 107 zone for quite some time. We had the break last week or week Friday. We had a test of that 107 break point, and it held, and it's moved all the way back up. We had a move back up to the 109s, 109 sort of 30, and that for now is looking like a short-term double top up there. So I think potentially we may be building another range, maybe 107 to these 109s. I'm not surprised that it's remaining up here and it's holding the break, with the Fed obviously seemingly maybe moving towards a pause and the ECB continuing to hike. That's the divergence trade in play there in favour of the euro. But I think while we stay up here, and particularly above the 108 level, then we've got every chance of having a look back at those 110 highs. I don't see us any situation where we're going to scream higher or scream lower, but range play is what we look at. Solid level up at that 109.20s. It's going to need a break of 109.40, which you can see there was the prior sort of high area after that move to 110s. So if you get a break above 109.40, then that's potentially a trade to go with, looking for a move back towards those 110 highs. If we get below 108, then maybe we're heading to 107. That's your downside level. Get back under there. Maybe we're going back in the box again. So, yeah, it's quiet, but there's, 200, 250 pips to play with. That's a decent range to make some money in all of this.
Yeah, most definitely. Maybe not as boring as I was thinking. I do tend to agree with you, though. I think although there does seem to be a bit of a narrative building of the ECB being kind of the only hawk left in town, or one of the only hawks left in town, I don't think that's enough to cause any huge rally in the euro, because, of course, you've got to remember not only are the Fed slowing rather than stopping their rate increases, but, of course, the other thing is, if you start to think about which economies are really quite exposed to rate hikes and tighter policy and all that kind of thing, the Eurozone is one that we know is very, very fragile. We know that also from a financial stability point of view, the banks in the Eurozone are not necessarily in the best of shape. So you then start to question actually how sustainable are those higher rates as well. So, yeah, I think, for me, I think if we do get nearer that 110 region, that would be perhaps where I would look to lean against some of that strength and start getting short. But again, for now, I think I'd rather sit this one out and see how things play out.
Yeah, well, you sit on your hands, mate.
Yeah, exactly. I was going to say, I'm going to have quite a relaxing week, actually, to be honest. No risks, no positions, crack a beer, away we go. Cool. Well, I am going to take one trade, and that's our play of the day. So let's get on to that. So, play of the day, I've got a little bit left field this week, and we're going over to Norway. Before we do that, I just want to mention last week's play of the day. I think I would have been stopped out within about half an hour of the video going live, but learning experience shows the importance of risk management and having those tight stops, particularly in the sort of markets that we're trading. Although it is notable that cable couldn't break through that 124 handle. And I think that is going to hold firm as relatively stiff resistance for now. I'm not going to get short cable once again, though. What I am doing is I'm looking to get short EURNOK. Why am I doing this? And why am I doing this despite having just said the ECB is one of the most hawkish out there? Well, there's a few reasons, to be honest. I think the Norges Bank have still got quite a lot of room to go when it comes to raising rates. You've also got some favourable seasonality, bullish NOK seasonality between here and about the middle of May. Can you tell that I was playing around with the seasonality function on Bloomberg over the weekend? You've also got quite nice correlations here with the Norwegian kroner and other asset classes. The NOK has a decent positive correlation with the S&P 500. So if you're bullish risk, that should help the Euro NOK to come a little bit lower. And, of course, the big one, the Norwegian kroner and its relationship with oil. The rally that we've seen in oil was looking more sustainable last week. Long positioning had come down to its lowest level since the war in Ukraine kicked off. China is reopening, but importantly, in more of a slow and steady manner. And the market doesn't necessarily seem to have woken up to that theme just yet. And of course, now you have the output cuts in the mix as well, which should put a little bit of a floor under oil prices and also help to support the Norwegian krone for now. So I would be looking to get short right around here, to be honest with you. This is more of a kind of medium-term view that I have. This isn't something that I would expect to pay off within the next sort of day or so. I would be looking to get out of this if we rise above the recent highs, which are around 11.5. Initially, I'd be looking for the bottom of the recent range to break around 11.20, and then over the longer term, if that move does gather a bit of momentum, easy for me to say, and we can get below the 50-day moving average, then you'd look towards the 11 handle. Ryan, I know you're playing the total opposite of my idea because I think you're bearish CAD, aren't you?
Yes, I'm a bit bearish CAD, more a technical play, and dollar CAD I'm looking at the moment. We've got a quite an important fib here, which was the rally from February, the 61.8, right on the 135 handle. And so technically, this is where I'm looking potential for longs and pretty quick trades. I'm not looking to sit in this for weeks or anything like that. Technical longs off this fib, and I think this morning we have had a little bit of a breakdown to sort of 88, 89, and a bounce above it. So here is the long trade that I'm looking at from this. But you mentioned oil, you mentioned inflation. I'm looking for potentially, if it does go against me, to flip into a short. Say we break 134.80. If oil continues going higher, then we're going to potentially get a move down to sort of 133s, 134s. The bottom of that range that you can see there. And the loonie likes to play nicely sometimes within the tech there. As you can see, we've got a bit of a wedge developing, and it's playing from top to bottom very nicely. So if it does go on the wrong side and does go below 135, 134, 70, 80, look to flip it into a short and run it down perhaps to those lows down there. Obviously, you're going to need oil obliging. We have a big level in oil, WTI at 82.50. If we break there, then that's going to give this one going south. But in the interim, longs off of 135, maybe look for 30, 40, 50 pips, lock in your stops behind it and see if it does push higher.
Good stuff. Well, with that brings us to the end of another show. Thank you as always for watching. If you've enjoyed the show, please drop a like on the video, leave a comment, let us know how you're trading the markets and your thoughts on some of the ideas that we presented. Big thanks to Ryan Littlestone from Forex Flow Live and Forex Analytics for interrupting his holiday to come and film the trade-off with us. We'll let you get back to the beach and put your feet up in the sun. Thank you as always also to our producer Kyriakos for pulling this all together so brilliantly. All three of us will be back this time next week, so we will see you then. Thanks as always for watching, and goodbye for now.